Hi, my name's Lee Thurburn, and in this video series, we're going to develop a tool, a worksheet, a spreadsheet that you can use to analyze the desirability of an income producing property investment. The focus will be, and the primary example will be built around a multifamily income property, an apartment complex with 194 units. But the spreadsheet and the process that I'm going to show you step by step, piece by piece, can be used for any kind of income producing property, whether that's a single family residential house that you've bought and you want to lease out, or whether it's a large apartment complex, anything in between. It could even work, or will even work, for retail space or warehouse space with a few minor adjustments. So that's what we're going to do. But the first thing I thought I would do is start off with what I think of as the 30-second MBA program. There are only 3 ways that any business can make more money. And this is super simplified, but it boils down to get more customers to come in the door, sell more to the customers that you do have, or cut your costs. And of course, there's a limit to what you can do with cost cutting. Now, when it applies to real estate, getting more customers in the door generally means lowering your vacancy rate. Vacancies are 0 cash flow periods of time, and every income producing property is going to have some level of vacancy. So we're going to talk about, we're going to discuss that. We're also going to talk about selling more to each customer. With income producing property, that basically means raising the rents. And then the third thing is cutting costs. And cost cutting, cost containment is something you should always be looking at in any business that you're operating. So the first thing that you need to understand is how income producing properties are valued. And they're valued primarily around one factor, and that is your net operating income. Now, net operating income is your gross revenues minus your operating expenses. Operating expenses are all of the things like utilities and payroll and materials and all of those kinds of things that are necessary to keep the property running. They do not include depreciation or mortgage payments or amortization, any of those kinds of things. So that's what net operating income is. But it does include taxes and other expenses that you have to pay to keep the property operational. Now, the value of a net income or an income producing property is centered around the concept of the net operating income and also what's called a capitalization rate. So a capitalization rate is really the annual net operating income divided by the purchase price of the property. So that's one way to look at it. But if you don't already know what you're going to pay, you may know what the net operating income is for a property, because if you're thinking about buying one, you're going to have a set of financial statements from the previous owner, and they're going to disclose what the previous owner has in the way of a net operating income. You'll be easily able to take that and divide that dollar amount by the property's purchase price, or the price they're asking, and it'll come up with a couple of different metrics, either a cap rate multiplier, or you can also come up with a cap rate percentage. Now, that doesn't give you any guidance as to whether or not you should or should not pay that price, but that is how the price of income producing properties, the value, is calculated. So, for example, if you have let's say that you have an expectation that you'll earn 5% per year on a property, or maybe alternatively that currently you could put your money to work at other investments opportunities that you have and earn a 5% rate. Well, that would give you the expectation that if you put your money into an income producing property, that you should earn at least a 5% rate of return on it. So you might utilize that as your cap rate to value the property. Well, 5% as a cap rate would indicate a multiplier of 20. 0.05 divided into 1, or divide 0.05 by 1, and that gives you a multiplier of 20. So a multiplier, a cap rate multiplier of 20, is equivalent to a capitalization rate of 5%. So hopefully that all kind of comes together in your mind. We're going to spend more time on it as we get through the worksheet and look in more detail at that. So there are, generally speaking, 5 ways to make money in real estate, in particular multifamily properties, but this is true of all real estate. First is through the appreciation of the property, the growth in the value of the property over time. Now, we've already talked about the value of the property being tied directly to the net operating income that the property generates. So in large part, the growth in the appreciation of the property over time is a function of how good you are at creating cash flow. So cash flow comes directly from your rental income, so it's income minus your operating expenses. So your cash flow also has the value of creating positive cash flow while you're waiting to sell the property in a few years. So not only do you make money from the appreciation, but you make money from the excess of your rents over your expenses during the time frame that you own the property. You also can add value to the property, and adding value is typically doing things like resurfacing the parking lot, restriping the parking lot, adding granite counters to the apartment units, repainting the apartment, improving the landscape, all the things that you can do to make the properties in both interior and exterior more desirable to people. The more desirable your property is, the higher your rent rates and the lower your vacancy rates. So those two things come together. Now, you also have an expectation and in fact a reality of an annual rent increase that happens pretty much every year. Now, this is the end of August of 2022, and here in the Dallas-Fort Worth area, currently rental rates are going up by anywhere between 10 to 20%. So if you're in an apartment in the DFW area and you've just had a renewal of your lease, you've probably seen it go up anywhere between 10 and 20%. I've even heard of some increases higher than that. Long term, 5% to 10% is a very common number in most market areas. We're in kind of a unique situation right now. And then finally, the fifth thing is depreciation. Depreciation is an expense that you can take against your other ordinary income because you are the owner of a commercial asset, an asset generating revenue. Now, we're going to talk just a second about depreciation. I am not currently a CPA. Been one in the past, but I'm not currently one. And so I'm really not going to provide any tax advice to you. But generally speaking, commercial real estate allows you to take an accelerated depreciation so that you get a bigger depreciation deduction in the first years as opposed to the latter years. That accelerated depreciation can result in a depreciation deduction as high as, say, 70% the year you purchase the property, which means that if you were to, say, invest $100,000 as a passive investor in a property or as the owner of a property, you might be able to deduct as much as $70,000 against your other ordinary income. Well, if your other ordinary income was large, your tax rate may very well be in the 35% per year range. So being able to lower your taxable income by $70,000, if you apply 35% of $70,000, you end up with a $24,500 deduction in your taxes or reduction in your taxes. So making an investment in commercial real estate, the depreciation, accelerated depreciation benefit alone could lower your actual upfront cash investment cost when you net the $24,500 against the $100,000 could reduce your investment cost by something in the neighborhood of 25%, so that the actual out-of-pocket cost to own the property or invest in the property is lowered from $100,000 to about $75,000. So that's the big benefit of depreciation. But don't rely upon what I just said. Make sure that you understand how depreciation is going to be treated by if you're a passive limited partner investor. Make sure you understand how that's going to be treated by the syndication that you're participating in, or have to have a conversation with your tax accountant or tax attorney to make sure that you know what the benefit is going to be on your individual income taxes, because there's a lot of variables there that can affect what you'll get. Okay, let's now build a worksheet. We're going to build it around the 4 variables that are the things that you typically will actually be able to manipulate and on a regular basis. And before we do that, I want to talk about a couple of general things. So first of all, we're going to look at each one of the different things, not only just revenue and expenses, but we're going to go through the expenses on a granular expense by expense basis, and we're going to talk a little bit. But generally, you're going to look at each one of these income or expense categories and look at the change over time that's going to happen because of the unique market conditions that you have in your market. Now, I'm going to build an 8-year horizon spreadsheet. Most properties are actually sold in the 5 to 7 year time frame. And I'm going to do 8 years just because it certainly covers the average 5 to 7 year time frame, which most properties are held and then sold. So you may not know this, but most commercial properties go through a change of ownership most of the time, about every 5 to 7 years, for a whole variety of reasons. So we're also going to build the spreadsheet in a fairly complex, or complex is the wrong word, a fairly sophisticated and detailed manner, so that each one of the individual expense items has its own growth rate projection variable that you can go in and do a detailed analysis of what those expenses will do in the way of changing over time, and then you'll be able to see what the impact is over time on the return on investment that you're expecting to receive from the property. Now, if I can help you, here's my contact information. I often help people find attractive multifamily properties into which syndicated deals that they can participate in. I'm also a flat fee residential broker and a business coach, and as well as a professor at a local university. So if I can help you with any of your investment decisions, please reach out, give me a call, send me an email, and let me know what you need, and we'll have a little conversation to see if it's something I can help you with. Thank you.